Stock futures higher after President Trump announced a trade deal with Japan. Joining us right now is Matt Powers. He's managing partner at Powers Advisory Group. Good morning to you, Matt. The markets are moving. I don't know how much you can take away from this deal relative to whether you think this is a model or a framework for others. And if it is that already baked into the cake? How much of it is, and how much does the market then have to run if not?
Yeah, good morning. Thanks for having me. Yeah, it's a good question, and it's news to us. Obviously, the Japan deal wasn't expected necessarily, but to set it up a little bit, we're all aware that we've had this rally since the April sell-off with the S&Ps up over 22%. It's easy to forget how unsettling that pullback was. At one point, the index dropped 15%. We had NASDAQ in bear market territory, and it was the fastest recovery in 50 years. But volatility has pulled back. I mean, the VIX is now at 16, so complacency is creeping in right now. It's all the core risks are still there. Tariffs, volatility with tariffs, Fed policy, valuation stretch, geopolitical, on and on. And they're also there, and it's kind of being pushed to the background. We've got this renewed concentration risk again. The Mag 7's almost dead on at a third of the S&P, which is up from where I think it was at its peak concentration levels like a year ago. So even though the index is hitting new highs, those gains are actually narrow and top heavy. And so where we're at right now, you start looking at tariffs, and August 1st is I think our big date, regardless of what just happened with Japan. And you can tie that into inflation. Tariff-driven inflation isn't the same as demand-driven, but it does complicate the Fed's job just the same. I mean, companies don't want to launch projects and see input costs spike. AI infrastructure, tech-related, a little bit different. I mean, spending hasn't slowed there, so it's a mixed picture. But bottom line, tariffs may push inflation higher and complicate some of the Fed policy, but short-term corporate spending decisions, as long as growth holds up, I mean, the impact should be manageable.
Manageable. The reason I ask, though, is do you have a sense that if we get deals with the EU, if we get deals with India, that on the back of that unto itself, that there's meaningful moves in the market that could still take place? Yeah,
on those lines, it's actually nice to kind of have conversation shifts from tariffs to actual corporate earnings. It's a little bit different. We're knee deep in earnings season, and we're in this high valuation, low volatility environment. So regardless where we are with the EU, we think deals will get done. Valuations are stretched, and there's no argument there. We've got the S&P is trading at 23 times forward, and it's well above that long-term average, which is around 17 roughly. Going back into that concentration risk, the equal weight's trading at 20 times. So, we're almost looking more at Q2 results to see what impact tariffs have already had, and the rest of it's unknown at this point.
So, in terms of just the earnings season ahead and what we've heard thus far, we've had some people look at the bond market and suggest that a recession is coming. That is not exactly what the equity markets would be suggesting. I'm not sure that's what the bond market's suggesting either, but where do you land there?
Yeah, that's a great question. And, one of the biggest themes in our conversations with our clients is how do you re-enter after you sat out that April pullback? Or just how do you reposition a portfolio in general with everything going on? Or how do you reposition it all? Tying into what you just said, recession-wise, bond, what do you do going forward? If you were waiting for clarity right now, you'd feel like you're chasing, but you don't want to play catch up right now. It's there. You have to avoid pockets of froth, period. I mean, it's definitely a stock picker's market. I mean, there's no need to buy broad sectors or ETFs just to stay invested. So if you do own them, keep them. I mean, but also put some focus on individual companies, with attractive relative valuations. They're out there. We love strong dividend growth. I think right now is a time to look longer term and just look at attractive entry points.